Cryptocurrency, particularly Bitcoin, has become a focal point of global financial strategy, attracting the attention of major financial players such as BlackRock, Vanguard and State Street. These institutions, often seen as forming the backbone of modern financial capitalism, are aggressively entering the cryptocurrency market, specifically targeting Bitcoin as a long-term investment opportunity. The media is abuzz with speculation about why these institutions are suddenly buying billions of dollars worth of Bitcoin. One perspective, offered by media mogul James Heckman, sheds light on a potential secret agenda behind BlackRock's moves. Heckman believes that when institutions of this magnitude begin accumulating an asset like Bitcoin, it signals something significant on the horizon. His argument suggests that these entities are not merely investing, they are positioning themselves to shape the future of cryptocurrency. According to Heckman, BlackRock and its affiliates only invest when they expect massive returns, often in the realm of 20 times or more, signaling a tectonic shift in the market. With these institutions behind Bitcoin, he believes it's an indicator for others to follow. The script aims to delve deeper into the reasons behind this aggressive investment and what it could mean for the future of crypto, especially in light of the upcoming US elections. In just the past few days, BlackRock has accumulated over $1 billion worth of Bitcoin. This aggressive purchasing strategy has raised eyebrows across the financial world, with many speculating on the reasons behind it. Heckman asserts that BlackRock's moves are never random. The institution does not invest unless it has substantial knowledge of potential future returns. The fact that they are pouring billions into Bitcoin suggests they expect a major surge in its value, possibly up to 20 times its current price. This is not just an opportunistic play, it's a calculated investment that could reshape the future of cryptocurrency markets. Heckman's take is that when major institutions like BlackRock, Vanguard and State Street accumulate assets, it signals an opportunity for smaller investors to follow suit. These institutions have the resources and influence to push an asset's value higher through their sheer financial weight, and Bitcoin's current value of around $60,000 per coin could be just the beginning. While BlackRock's investment in Bitcoin is drawing attention, another related event is Ripple co-founder Chris Larson's donation of $10 million in XRP to Kamala Harris's election campaign. This move has raised questions about the relationship between cryptocurrency and politics, especially given its timing so close to the US elections. Why would Larson make such a large donation when it seems unlikely to affect the election's outcome? Heckman suggests that this donation is not a mere political gesture, but a strategic move tied to the broader cryptocurrency landscape. He speculates that Larson, like BlackRock, knows something about the future of crypto regulations under a potential Harris administration. His decision to publicly support Harris could be seen as a defensive strategy, anticipating stricter regulations for altcoins while positioning Ripple favorably in the eyes of regulators. This intertwining of political donations and crypto investment strategies hints at a deeper connection between politics and the future of the crypto market, particularly how key players like Ripple are aligning themselves ahead of regulatory changes. Heckman argues that the actions of Ripple and BlackRock are not isolated incidents, but part of a broader, interconnected strategy. These institutions are not only influencing the cryptocurrency market, but also positioning themselves within the political arena to ensure favorable outcomes. The triad of BlackRock, Vanguard and State Street, along with their subsidiaries like iShares, Goldman Sachs and JP Morgan, wield enormous influence over global financial and political systems. Their investments in Bitcoin, coupled with strategic political donations, indicate a coordinated effort to shape the future of both the crypto market and government policies. Heckman emphasizes that when institutions like these make moves, it's not just about financial gain, it's about exerting influence on a global scale. In the context of the US elections, their actions could have far-reaching implications for how cryptocurrencies are regulated and adopted in the mainstream economy. The influence of BlackRock, Vanguard and State Street extends far beyond financial markets. These institutions have significant sway over political decision-making, especially in areas like financial regulation. Heckman suggests that when these players start investing heavily in an asset like Bitcoin, it's not just because they expect it to increase in value, they also expect to shape the regulatory environment in their favor. This is particularly relevant in the context of cryptocurrencies, which are still in a regulatory grey area in many countries, including the US, with BlackRock backing Bitcoin. It's likely that future regulations will favor Bitcoin and other mainstream cryptocurrencies like Ethereum, while altcoins may face stricter scrutiny or even be pushed out of the market. Heckman draws parallels to how these institutions have influenced other industries such as media, agriculture and technology through strategic investments and lobbying efforts. By consolidating power and controlling regulations, they have historically been able to dominate markets, and cryptocurrency appears to be their next target. Kamala Harris and the crypto market, the Ripple connection. The donation from Ripple co-founder Chris Larsen to Kamala Harris's campaign is seen as a signal of how political outcomes could affect the crypto market. Heckman argues that this donation is not just a political endorsement, but a strategic move to position Ripple favorably in a future where Harris is in power. He speculates that under a Harris administration, the United States government may implement regulations that heavily favor institutional players like BlackRock, while altcoins may be subject to more stringent rules. This could lead to a consolidation of the market, with Bitcoin and Ethereum thriving due to institutional backing, while smaller altcoins struggle to survive. Ripple's donation to Harris can be viewed as a way to ensure that it remains on the right side of future regulatory changes. In Heckman's view, the timing of the donation, so close to the election, indicates that Ripple believes Harris is likely to win, and they are positioning themselves accordingly. The immigrant voter strategy and political calculations. Heckman also touches on the broader political strategies at play, particularly the use of immigrant voters as a potential swing factor in United States elections. He suggests that the Democratic Party has strategically placed millions of new voters in key swing states, which could tip the scales in Harris's favor. This, in turn, would have significant implications for the cryptocurrency market, as a Harris win could lead to regulatory changes that favor institutional investors. Heckman argues that this is part of a larger, well-planned strategy by the Democratic Party to secure victory, and that players like Ripple are aligning their financial interests with this political reality. Whether or not this theory holds, it reflects the complex interplay between politics, immigration, and financial markets, with cryptocurrency at the center of it all. Bitcoin's regulatory future, institutional backing and growth. One of the key takeaways from the script is that Bitcoin's future is closely tied to the actions of major financial institutions like BlackRock. With BlackRock, Vanguard and State Street heavily invested in Bitcoin, it is unlikely that regulators will impose restrictions that would harm its value. Heckman suggests that these institutions have too much influence over policymakers to allow Bitcoin to be regulated out of existence. Instead, he believes that Bitcoin will continue to grow, possibly reaching a value of $500,000 per coin or more in the long term. This prediction is based on basic supply and demand economics. As more institutions accumulate Bitcoin, the supply will dwindle, driving up the price. Heckman also points out that major banks, including Goldman Sachs and JP Morgan, have started accumulating Bitcoin, further signaling that institutional players are preparing for a major price surge. While Bitcoin and Ethereum are likely to thrive under future regulations, Heckman warns that altcoins could face a much tougher road ahead. He predicts that non-Bitcoin digital assets will be heavily regulated, potentially pushing many of them out of the market. This would be similar to what happened in other industries, such as media and agriculture, where large corporations used regulatory changes to consolidate power and eliminate smaller competitors. Heckman argues that we are already seeing signs of this in the crypto market, with institutions like BlackRock accumulating Bitcoin, while altcoins face increasing regulatory scrutiny. This could lead to a significant shrinking of the altcoin market, leaving only a few major players standing, much like what happened with other industries that underwent consolidation. Heckman draws historical parallels to other industries where large financial players have used regulation to consolidate power and eliminate competition. In the media industry, for example, companies like Google and Facebook were able to dominate by controlling advertising networks and pushing out smaller players. Similarly, in agriculture, companies like Monsanto were able to consolidate control through regulatory changes that favored large corporations over small farmers. Heckman suggests that the same pattern is now playing out in the cryptocurrency market, with BlackRock and its affiliates positioning themselves to dominate through regulatory influence. He argues that this is a well-established pattern in modern capitalism, where large financial institutions use their power to shape markets in their favor. Heckman's ultimate prediction is that Bitcoin will become the next trillion-dollar asset class, much like Apple, Amazon, and Google. With institutions like BlackRock accumulating large amounts of Bitcoin, it is only a matter of time before its value skyrockets. Heckman believes that Bitcoin's potential as a store of value, combined with its limited supply, makes it an ideal candidate for massive price growth. He also points out that Bitcoin has already proven its resilience, surviving multiple regulatory crackdowns and market crashes, and coming back stronger each time. With institutional backing, Bitcoin could become one of the most valuable assets in the world, and Heckman encourages investors to follow BlackRock's lead by accumulating Bitcoin before its price rises even further. Bitcoin price predictions: $500,000 and beyond. Heckman's prediction that Bitcoin could reach $500,000 or more per coin is based on a combination of institutional backing, limited supply, and increasing demand. He argues that with institutions like BlackRock, Vanguard, and State Street accumulating Bitcoin, its price is likely to rise significantly in the coming years. Heckman also points out that Bitcoin's supply is fixed, with only 21 million coins ever to be mined, making it a scarce asset in a world where demand is only increasing. As more institutions and retail investors buy Bitcoin, its price will inevitably rise, possibly reaching $500,000 or more in the next decade. This makes Bitcoin one of the most attractive investments in the world right now, according to Heckman. In conclusion, Heckman emphasizes that investors should pay close attention to the actions of BlackRock and other major financial institutions. These players have a track record of making smart investments that yield massive returns, and their recent accumulation of Bitcoin is a clear signal that they expect the cryptocurrency to rise in value. Heckman encourages investors to follow their lead, suggesting that those who get in early will benefit the most. He also warns that the crypto market is likely to undergo significant changes in the coming years, with regulations favoring Bitcoin and Ethereum while altcoins struggle to survive. The key takeaway is that institutional backing will drive the future of cryptocurrency, and those who align their investments with BlackRock's strategy are likely to see substantial returns.